Today's lesson will be Chapter 13, Problem 5B. West Yellowstone Outfitters Corporation manufactures and distributes leisure clothing. Select transactions completed by West Yellowstone Outfitters during the current fiscal year are as follows. On January the 15th, split the common stock 4-for-1 and reduced the par from $120 to $30 per share. After the split, there were 800,000 shares of common stock outstanding. Sometimes what a corporation will do in order to get the market value of their stock to go down to where it can be affordable for more potential buyers of the stock, they will split their stock. In this situation, they had 200,000 shares before the stock split. If we split the stock 4 times for 1 share, then what we would do is we would multiply 4 times the 200,000 to give you the number of shares of common stock that will be outstanding at 800,000. So they had 200,000 before the split. If they split it 4-to-1, they're going to have 800,000 shares of common stock that are issued and outstanding. This makes the stockholders happy because they actually have the same amount of shares, but it also will stimulate the sale of the stock because it will allow the market price to become lower. The market price will actually be split 4-to-1 too. It also will split the amount that's printed on the stock certificate itself. Before the stock split, the par value was $120. If we divide $120 by 4, since they split the stock 4-to-1, the remaining par value will be $30 per share after the split. So it splits the par value, it gives the stockholders more shares of stock, and it reduces the market price. That's why we would do a split. To record this split on our journal, there would be no entry required. So where they have the journal and they want you to fill in the amounts here, there really would not be a journal entry here. So select no entry required. That is the correct answer for the journal for January the 15th. There would be no journal entry required. It's like a memorandum entry. They would write it down. They would show that they had split the stock, but it really did not do anything to the accounts. The accounts dollar amount will stay the same. On March the 1st, we're going to declare semi-annual dividends of 25 cents on 100,000 shares of preferred stock and 7 cents per share on 800,000 shares of the $30 par value common stock to stockholders of record on March 31st. It will actually be payable in April. When we declare a dividend, we're just stating that we are going to be paying dividends. We will not pay the dividends until April 30th. But on the date of declaration, you have to record a liability account because your corporation is obligated to pay the dividends that they said that they would do. These are going to be cash dividends. Notice there are dollar amounts of dividends here that they're giving you. There are two classes of stock that we're going to use, so there will be two calculations in determining the amount. And in Cengage, what they've done is they've combined it all into one journal entry. So technically, in the real world, you could have created two journal entries, one for the payment of the preferred stock and one for the payment of the common stock dividends. But in this case, they combine them all together. So we're going to have to do some computations that will allow us to combine the amount that we owe to our preferred stockholders and the amount that we owe to our common stockholders. These would be added together to find the amount. The accounts that you would be debiting would be our dividends account. Since these are cash dividends, we're going to call it cash dividends. Cash dividends are going to increase on the debit side, so we're going to need to debit those accounts. And what you need to know is the amount of the shares of stock for each class of stock and the amount of the dividend that we're going to be paying for each class of stock. So we're going to begin by calculating the preferred stock dividend. The preferred shares were 100,000 shares. So 100,000 shares would be multiplied by 25 cents for each share of stock. The total dividends for the preferred stockholders is 25,000. So I want you to write that down. Hold that thought in your mind. 25,000 is going to be paid to our preferred stockholders. Then what we're going to have to do is figure out what we're going to pay to our common stockholders. Our common stockholders have 800,000 shares outstanding. The outstanding stock is what we pay dividends on. 800,000 shares of stock are outstanding. The amount of the common stock dividend per share is 7 cents. So we're going to multiply 800,000 times 7 cents, and that will give you the amount of the dividends for common stock, which are 56,000. This 56,000 has to be added back to the preferred stock dividends that we calculated earlier that were 25,000. So the total dividends that we're paying is 81,000. Again, this was a combination entry for both the preferred stock dividends and the common stock dividends. Because the March 1st is when we declared the dividends, we have to create a liability to record the fact that we're obligated now to pay the dividends on April the 30th. So that liability is going to be called the cash dividends payable. And it will be increasing. To increase the liability, cash dividends payable, you would credit. On the April 30th transaction, we're going to actually pay the cash dividends that we recorded earlier. So on April the 30th, our liability account is going to decrease, called cash dividends payable. It will decrease by the amount that we owed, which was 81,000. Our credit will be to the cash account for 81,000. On May 31st, we purchased 60,000 shares of the corporation's own common stock at $32. We're going to record the stock at cost. We record it at cost because it's treasury stock. Treasury stock is a contra stockholders equity account that has a normal debit balance. It increases on the debit side. We're going to debit this treasury stock for the number of shares of stock that we bought back off of the market, and we're going to multiply that by the cost of those shares of stock, or what we paid for those shares of stock, which will be 1,920,000. Since we bought back our own stock, we're going to credit our cash account for 1,920,000. In the next transaction, we actually sold some of the treasury stock that we purchased on May the 31st. We sold it at $38. Notice the cost of that stock was $32. So we had a profit, or we increased our paid-in capital from the sale of treasury stock by the difference. Because we sold treasury stock, our cash is going to be debited. The cash will be debited for the amount of shares that we sold times what we sold it for per share, which is $38. So 1,520,000 is the amount of cash that we would receive from the sale of the treasury stock. Our treasury stock is going to be decreasing. To decrease the contra stockholders equity account treasury stock, we would credit it for the 40,000 shares that we sold times what it cost us, which is $32. So 40,000 times $32 is 1,280,000 that would be credited to the treasury stock. You always credit your treasury stock for what it cost you. If we sold 40,000 shares and it cost us $32 a share, we multiply those to get the amount. The difference between what we bought it for and what we sold it for is an addition to the paid-in capital from the sale of treasury stock. The difference between these two, the cash that we received, 1,520,000, less what we paid for it, the cost of those shares, will give us an increase in our paid-in capital of $240,000. That increase has to go on the credit side. You could have also taken this amount, or found this amount, by taking the difference between these two, which is $6 times 40,000, and it will also give you 240,000. So there's two ways that you can determine the amount of that stock. On September the 1st, we declared semi-annual dividends of 25 cents on the preferred stock and 9 cents on the common stock. And this was before the actual stock dividend. So what you're going to have to do is determine exactly how many shares of common stock that you have, so that you will be able to determine the amount of the cash dividend that will be paid to the common stock. And you would also have to determine the preferred stock amount. I have created an Excel spreadsheet for you to look at for these calculations. So I'm going to move away from the Cengage screen I'm going to stop sharing it with you, and I'm going to share with you the Excel spreadsheet that I have created that will help you to understand the computations behind this particular part of the problem. First of all, what we have to do is we have to determine what the total shares are going to be at September the 1st. So our common stock shares that we had as of January 15th were 800,000. You'll remember that was after the stock split. They had 800,000 shares that they started with. Then on the May 31st transaction, we purchased treasury stock. In other words, we bought back 60,000 shares from the 800,000 shares of common stock that we originally had. Treasury stock, you cannot give dividends on them. So we're going to deduct these from the original amount of stock that we had before we can determine the number of shares that we have available for dividends. So treasury stock is going to be subtracted back from the original 800,000 shares when we're buying the treasury stock. Now on August the 17th, we sold the treasury stock, so we put it back out on the market, and this 40,000 that we sold of the treasury stock, we can give dividends on that. So in order to determine the total shares, we have to create a combination of the sum of the January 15th shares, the treasury stock that we bought back on May the 13th or 31st, and the amount that we sold of the treasury stock. We combine all three of these together to get 780,000. So 780,000 is the number of common shares that we have on hand at September the 1st that we can give dividends on. So to calculate the dollar amount of the dividends for the common stockholders, we're going to take the total shares of common stock, we're going to multiply it by the common stock dividend per share that was given in Cengage, and that will give you the common stock dividends. So what we did is we took our total shares of 780,000, we multiplied it by the common stock dividend per share, which was 9 cents, and that will give us total common stock dividends that we owe to our common stockholders at 70,200. For preferred stock, we need to know how many shares of preferred stock that we had. The amount was given to us as of March the 1st. The preferred stockholders' shares of stock that we had issued and outstanding was 100,000 shares. We're going to take this 100,000 shares of preferred stock, multiply it by the preferred stock dividend per share that was given in Cengage, and that will give us the preferred stock dividends. So we took the 100,000, we multiplied it by 25%, and that gives us $25,000 of dividends that we're going to give to our preferred stockholders. So what they're asking you for in the answer to the next journal entry that we're going to use in Cengage is the total amount of cash dividends that we're going to give to our preferred stockholders and our common stockholders on September the 1st. So what we do is we simply add the common stock amount of dividends, which was 70,200, plus our preferred stock dividends of 25,000 together. That will give you 95,200. That's the answer that we're going to put in our Cengage journal entry. So I'm going to flip back to the Cengage screen. And these were cash dividends, so we're going to debit cash dividends. We're not going to pay these dividends until later. When we're declaring the dividends, we're creating a liability for those dividends, which was cash dividends payable. And from the Excel spreadsheet, we got the amount of $95,200. The second part of this transaction also happened on September the 1st. The second part of this transaction, let me move my stuff away so you can see what it says here. It says a 1% common stock dividend was declared on common stock outstanding. It was to be capitalized at the fair market value of the common stock, which is estimated at $40. The dividend date of record is September 30th, payable on October 31st. So this is a stock dividend this time, which is different from a cash dividend. A stock dividend just means we're going to be giving stock out as a dividend in addition to the cash dividends that we paid earlier. So when we're talking about stock dividends, we're going to debit the account called stock dividends. It is debited because we're increasing the dividends account. And what you need to know is the amount of that debit. Now, what you have to realize is we have to go back to our Excel spreadsheet to determine how many shares of stock we had of common stock at September the 1st. And then we're going to multiply that by the $40, which is the fair market value, and that's how we're going to get the debit amount. So again, I'm going to stop sharing the screen here, and I'm going to flip back up the Excel spreadsheet so we can talk about this particular transaction. We're down here where we're calculating the common stock dividend. So to calculate the common stock dividend, we're going to take the number of shares of common stock that we had on September the 1st, which was the 780,000. We're going to multiply it by 1%, and that will give us the number of shares in the stock dividend. So I'm taking the 780,000, multiplying it by 1%, and that will give me 7,800 shares that are going to be in this stock dividend. We have to put a dollar amount on that. So we're going to take the shares of stock in the stock dividend, which is 7,800. We're going to multiply that by the market price of the common stock, and that will give us the price of the stock dividend. So 7,800 times $40 is $312,000. That's the amount of the price of the stock dividend. That's the amount that goes into Cengage. So again, I'm going to stop sharing the Excel spreadsheet with you, and I'm going to go back to Cengage, and we're going to put in the amount of the stock dividend, and the amount of the stock dividend was $312,000. The account that I need to credit is stock dividend distributable. on the date of declaration, we have to show the par value of the stock dividend distributable. And so again, I'm going to stop for just a second. I'm going to share with you the Excel spreadsheet that I prepared for you, and we're going to find the amount that we need to put in for the stock dividend distributable. And so we're down here. We're looking at common stock dividend distributable. We're going to take the common stock dividend, we're going to multiply it by the par value of the stock. The par value of the stock was $30. That came from the first transaction. You'll remember when we did the stock split, we had to split the par value. It came up to $30 for the par value. So the par value times the number of shares in the stock dividend will give you the amount of the stock dividend distributable. So we're going to take 7,800 and multiply it by $30, and that will give you $234. I'm going to stop sharing my screen again. We're going to share with you the Cengage problem, and we're going to put the amount in as the credit at $234,000. Again, this is on your Excel spreadsheet. And so the difference is the paid-in capital that's in excess of the par value on the common stock. That would be the difference between the debit and the credit. So 312,000 minus 234,000 will leave you with the plug figure of 78,000. So now our total debits and our total credits are equal. Again, the par value is used to determine the stock dividend distributable. The market value is used to determine the stock dividends. The difference between the market value and the total par value is the paid-in capital in excess of par on common stock that would increase this stockholders' equity account. Then we're going to pay the cash dividends. These are the cash dividends earlier that we needed to pay. The cash dividend amount was $95,200. So we're going to debit the liability account cash dividends payable to reduce it down to zero. We no longer are going to owe those dividends because we're paying them. It's going to go away. This account's going to decrease. And then we're going to credit our actual cash account because we're paying the cash dividends of $95,200. And on October the 31st, we are also going to issue the certificates for the common stock dividend. So this stock dividend distributable is going to go away. It was originally credited. Now we're going to debit it for $234,000. And we're going to actually issue the common stock. We're putting it out on the market now at $234,000. We're distributing the stock to the dividends to the stockholders on record. They're getting their shares of stock, which is the stock dividend. And that's all of this problem. So I'm going to stop sharing this with you, and we'll see you again the next time.